US stock markets are braced ahead of a meeting of the Federal Reserve at which central bankers could aggressively raise interest rates. Policymakers are considering a rise of 0.75 percentage points to combat inflation.
Some investors fear this could push the world economy into recession. On Monday, the S&P 500 entered bear territory for the first time in more than 2 years. Well, let's talk now to Susannah Streeter, who's an investment and markets analyst. Welcome back to the programme, Susannah. So the United States had another miserable day on Monday. Are we now at a point where a recession is looking more likely?
Well, certainly investors do seem to feel that that is the case. Certainly there is this real fear, I think, rippling through the market that inflation is simply becoming too hot to handle for central banks right now, and that they're going to have to aggressively hike rates to try and bring inflation under control. And the worry is that this aggressive stance is looking much more likely to push the US into recession. To some extent, there are indications that actually consumers are still relatively optimistic. They're still spending, but we're seeing a shift from goods to services much more, and we're seeing this spiral of prices higher and higher. There had been expectations that actually we could have reached a peak in terms of inflation, but that certainly hasn't been the case in the latest data that's come through from the Consumer Prices Index, and again from the Producer Prices Index, which is a precursor to those prices being passed on to the consumer. And they are very high indeed. And that is really causing these worries, and why the expectations are is that the Federal Reserve, the US Central Bank, could hike rates by 0.75% instead of the 0.5% expected. And that's what's really been frightening the horses on the financial markets.
So as you say, the Fed expected to take this drastic action to raise interest rates by more than had expected. But will it work to tackle inflation?
The problem that the Federal Reserve and other central banks around the world are grappling with right now is that they hope that by raising rates that will dampen down demand. The problem is a lot of the inflation is imported. It's coming in partly because of the war in Ukraine, which is pushing up commodity prices around the world. And these commodities are essential goods. They're fuel for your car. They're wheat to make bread, to make your daily bread. So it's not exactly as though many people can just say, well, I'm just not going to buy these products anymore. They have to. They're part of essential goods and services. And so that is why it's looking very difficult for central banks to really implement these tools that they have at their disposal to bring inflation under control. Because even if they do put up rates to try and dampen down demand, it won't necessarily translate into lower inflation very, very quickly, because a lot of these price increases are imported into the economies.
And we're also seeing a strengthening US dollar, which is causing trouble elsewhere as their currencies fall.
Yes, absolutely. And of course, remember, many of these commodities on international exchanges, they're priced in dollars. So actually, that means that a stronger dollar means that it's even more expensive for many countries to buy in those commodities, which leads to even higher prices that consumers have to pay. And of course, there are other kind of knock-on effects, which is causing the drop in currencies. You mentioned a little earlier in the headlines the speculation that Scotland might hold another referendum, and that's caused further anxiousness about the UK outlook and seeing the pound fall against the dollar. That's adding to inflationary pressures for the UK as well. So certainly, though, the stronger dollar, with this flight from riskier assets into the safe haven dollar, that's actually exacerbating the problem for many economies.
And we're also seeing tough times for cryptocurrencies, Bitcoin falling to an 18-month low. Do you think we'll see it bounce back?
Well, I think because inflation is proving to be a much trickier opponent in the ring than expected, you're seeing the likes of Bitcoin and Ether really getting a severe bruising. I expect this volatility that we're seeing in cryptocurrencies to continue while all these worries about inflation stay so high. Because what's effectively happening is if interest rates are pushed up, that's bringing the era of cheap money to an end. And it's all this cheap money that's been flooding the financial markets that's really fueled this rise in crypto as an alternative asset to invest in. But, you know, it's always been extremely volatile. People really shouldn't be dabbling with cryptocurrencies unless they're right at the fringes of their portfolio with money that they can really be prepared to lose. And this latest round really shows just how dangerous it can be financially to dabble in crypto. And lots of people, lots of ordinary people have put up their savings. Some have got into debt to do so into crypto. So this really should be a warning going forward for ordinary investors to only really plow into crypto if they can afford to lose money.
OK, Susannah Streeter, great to get your thoughts today. Thanks very much indeed for joining us.